Welcome to HPC News Bytes, a weekly show about important news in the world of supercomputing, AI, quantum computing, and other advanced technologies.
Hi, everyone. Welcome to HPC News Bytes. I'm Doug Black, and with me, of course, is Shaheen Khan. Reuters reports that the Trump administration is preparing restrictions on new Chinese data center equipment, with optical transceivers reportedly a particular focus. These components convert electrical signals into optical signals and back again, and increasingly form the nervous system of large AI clusters. Chinese vendors have become major suppliers. Reuters says Zhongji Innolight alone has roughly 27% global market share. The concern from Washington is that components embedded deep inside critical AI infrastructure could create risks of surveillance or malware insertion. The proposal is still under development, so the final scope is unclear, but it would move U.S.-China technology restrictions beyond just GPUs and semiconductor manufacturing equipment into the networking infrastructure connecting those processors. This comes at a sensitive time because AI clusters are driving rapid demand for 800 gigabit, 1.6 terabit, and faster optical links.
As AI and therefore compute increasingly become national infrastructure, the strategic boundary around them is expanding. Policymakers inevitably start asking what components and technologies are critical and where they come from. Optical technologies are especially interesting because they are finally becoming the drivers of overall performance. At data center scale, the ability to move data increasingly determines how much useful computation can take place. There's also an economic trade-off. Restrictions can improve security and strengthen Western optical suppliers, but Chinese suppliers hold significant capacity. So restrictions could more likely raise prices or slow deployments too, just when the US is racing to build AI infrastructure. Meanwhile, technology fragmentation continues, expanding through the bill of materials, from GPUs and memory to networking and software. The question, as usual, is how much supply chain independence is actually possible, how much countries are prepared to pay for, and whether security policy can move as quickly as the infrastructure itself.
Okay, sticking with the US-China technology rivalry, Changjin Memory Technologies, or CXMT of China, is becoming difficult for memory buyers to ignore. Chris Miller, who is a former guest on our podcast and author of Chip War, a book on the technological competition between the US and China, argues that using Chinese DRAM capacity to relieve current memory shortages could create a longer-term strategic dependency. CXMT is now the world's fourth largest DRAM producer, and they're growing rapidly. Miller notes that it can still purchase some advanced Western semiconductor equipment, though it lacks access to EUV lithography used at the leading edge. At the same time, reports indicate that HP, Asus, and Acer have begun using limited amounts of CXMT memory in notebooks for markets outside the US as manufacturers search for additional supply. That does not mean CXMT can solve the global shortage overnight. The established market remains dominated by Samsung, SK Hynix, and Micron, but a fourth supplier with substantial Chinese state backing is arriving precisely when AI demand has made memory unusually scarce, expensive, and strategically visible.
All computers rely on a tiered memory-to-disk hierarchy that is optimized for cost, speed, and persistence. Fast memory is expensive, so you try to use less of it, and that means you must complement it with a layer below it that is less fast and less expensive, and on, thus forming a hierarchy. And at some point, you need non-volatile storage, and that extends the hierarchy to disks and tapes. Because AI applications need a lot of memory, they have caused a domino effect, starting with memory that is packaged right with GPUs, the so-called high bandwidth memory, or HBM. HBM is in high demand and also happens to be the most profitable. So manufacturers would naturally want to prioritize it over all else. But a full system also needs plain DRAM memory and SSDs and disks. Otherwise, nobody can use it or can buy it. So the manufacturers need a balancing act. The net result is a ripple effect that has led to restricted supply and inflating costs for even standard computer RAM and SSDs downstream. So more capacity for the mid-tier DRAM can bring in more memory supply now and relieve pressure on costs. But policymakers worry that solving the shortage with heavily supported Chinese capacity, even for ordinary components, could create future strategic dependence long before anyone notices they have become strategic. Policymakers could block CXMT, but it's a pretty global market, and some relief would be felt as vendors would likely direct Chinese components to countries that are okay with that, as you mentioned. Memory used to be treated largely as a commodity semiconductor business, and at the mid to low end, it continues to look that way. But AI has split the market at the high end because HBM has an outsized influence on the whole market and on how quickly AI infrastructure can be deployed and at what price. All memory vendors are expanding capacity. That's the structural solution that will start showing up in the next 12 to 18 months.
The AI buildout is becoming increasingly debt financed at astronomical levels. The question is, how long can it last? An article in Fortune magazine citing S&P Global reports that hyperscalers and related companies have already issued about $225 billion in bonds in 2026, putting them on pace for roughly $400 billion for the year. But that's only visible debt, which is just part of the commitment. Fortune cites estimates of about 1.2 trillion to up to 1.65 trillion in off-balance sheet or, quote, debt equivalent obligations, much of it involving long-term data center leases and commitments to acquire GPUs, servers, and other infrastructure. These are generally legitimate and disclosed obligations rather than secret debt, but they illustrate how much future capital has already been committed. The hyperscalers still have exceptionally strong balance sheets and investment-grade credit. Yet investor demand is showing some signs of fatigue and borrowing spreads are increasing. AI infrastructure is pushing companies historically associated with asset-light software economics toward a far more capital-intensive operating model.
The AI boom is often likened to the internet growth and bubble a couple of decades ago. Likewise, AI infrastructure is viewed as behaving like telecom, energy, or transportation infrastructure, where you need to finance capacity before you see revenue. In many countries, that sort of infrastructure needs government help to get going. Once companies have signed long-term leases and hardware commitments, utilization becomes extremely important. An idle GPU cluster still depreciates, consumes financing capacity, and risks technological obsolescence. But hyperscalers continue to generate enormous cash flows, as you mentioned, and AI demand is expected to continue, and possibly fast enough to absorb the infrastructure. But the downside becomes less forgiving. Falling inference prices, efficiency improvements, excess capacity, or a change in model architecture could all affect returns on facilities already committed years ahead. Balance sheet strength, therefore, becomes part of AI competitive advantage alongside chips and software and power. None of this proves that the AI build-out is a bubble, but it does show that the financial engineering of AI is just as complex as its hardware and software engineering, and especially as technology companies become infrastructure operators and face a new kind of risk profile.
Speaking of AI hardware engineering, news came out last week that AMD is acquiring Toronto-based Talus, a startup developing highly specialized silicon for AI inference. Talus takes an unusual approach. Instead of running a model as software on a general-purpose GPU, it turns a specific model into custom hardware, including hardwiring much of the model's structure and weights into silicon. Talus says it can take a new model into custom silicon in about 2 months and has demonstrated Llama 3.1 8B inference at roughly 17,000 tokens per second per user on its HC1 chip. AMD plans to integrate Talus into its accelerator roadmap and combine it with their Instinct GPUs at the system level. Thales was founded in 2023 and has raised about $219 million. Financial terms were not disclosed. The deal follows several other AMD acquisitions aimed at strengthening AI inference and software capabilities.
We'll see how AMD absorbs this acquisition and whether the design strategy is incorporated into AMD GPUs or in chiplets or discrete products. For example, at the embedded edge, where functionality is well defined and more or less fixed for a long time and is able to support a big enough market. And that seems to be the bet here, that A, models become good enough and stable enough to be burned into silicon, and B, inference will fragment enough to create markets that can use fixed models in sufficient volume. Historically, special-purpose devices have ended up yielding to next-generation general-purpose machines. But AI has a big energy problem right now, and this kind of technology can help in some segments. It is also possible that AI, like some networking or telecom equipment, could have general-purpose processors coexisting with very specialized parts. But at the end, if you're going to set it and forget it, then you'd better not need to change it anytime soon. All right, that's it for this episode. Thank you all for being with us.
HPC News Bytes is a production of Orion X. Shaheen Khan and Doug Black host the show. Every episode is posted on orionx.net. If you like the show, please rate and review it. Thank you for listening.